Over the past few months, the financial world has been transfixed by an unexpected plot twist. The resurgent US dollar that had been confounding economists and humbling hedge fund titans has begun to lose its mojo. It's a counterintuitive development that on its surface seems to defy logic, but dig deeper and you'll uncover deeper currents reshaping the global economy. At first blush, the dollar's renewed swoon seems paradoxical. After all, the U.S. economy has been an island of relative strength amidst a sea of struggles, from the energy crisis rocking Europe to China's sputtering post-COVID recovery. The labor market remains remarkably resilient, with unemployment hovering near historic lows. And while inflation has begun to moderate, price pressures remain stubbornly high. Conventional economic models would suggest the dollar should be gaining vigor, not suffering a relapse. For years, the Federal Reserve's aggressive interest rate hikes to combat runaway inflation had turbocharged the greenback, as global financial flows rushed towards the alluring yields of U.S. debt. After watching their currencies be eviscerated against the muscular dollar, beleaguered central bankers from Tokyo to Frankfurt breathed a sigh of relief when the rally went into reverse in recent weeks. But in today's topsy-turvy times, the counterintuitive is becoming the new normal. While the U.S. economy remains sturdy, there are emerging signs of strain, from a precipitous housing slump to flagging retail spending. Data disappointments, particularly a recent anemic jobs report, have pierced the aura of American exceptionalism. If growth downshifts faster than anticipated, that could force the Fed to tap the monetary brakes more forcefully. And that simple prospect of the Fed not just pausing but actually reversing course on rates later this year is what's flipping the dollar script, at least for now. Financial markets have swiftly recalibrated, now pricing in as many as 2 quarter-point rate cuts in the coming months. The result has been a broad repricing of global asset prices. The dollar has weakened, U.S. Treasury yields have retreated, and stock markets from New York to London have rocketed to new highs. To the casual observer, this repricing may seem overdone, a fleeting bout of euphoria detached from economic fundamentals. But dig beneath the surface and you'll find a deeper reckoning at work in global markets. For years, the Fed's aggressive tactics inadvertently exported financial instability around the world as the rampant dollar wreaked havoc on indebted nations and emerging markets. Now, investors are betting that any let-up from the Fed rate hike regime will help relieve the global financial strains, a view clearly welcomed by officials like Japan's finance minister, who have lately been forced to spend billions propping up their battered currencies. Easy money from the Fed has long been a pacifier for frothy global markets, and anything that postpones or reverses the tantrum phase is being celebrated on trading floors. Of course, any analysis of today's whipsawing currency moves demands a broader perspective. While the Fed's policy plans are dominating the micro-narrative, there are powerful secular forces at play reordering the very anatomy of global capital flows that may ultimately prove longer-lasting than any monetary policy cycle. For the better part of 2 decades, we lived in an era of unfettered free trade, free movement of capital, and free flow of goods, labor, and ideas across border. Multinationals flourished in this laissez-faire environment, erecting global supply chains that crisscrossed the world in a ceaseless quest for efficiency. Financial elites celebrated peak globalization, in which the artificial boundaries of nations seemed increasingly obsolete. That era appears to be waning, if not dead. The last few years have crystallized for national leaders the downsides of global integration, from supply chain vulnerabilities to technological dependence. Self-sufficiency is the new shibboleth, and the great powers are busily constructing high walls to safeguard their economic interests from external shocks and rival adversaries. This decisive turn towards isolationism and protectionism has profound implications for currencies. After decades of capital sloshing across borders with few restraints, we could be entering an era of home economies, as multinationals are compelled or incentivized to reshore investment in their native regions and markets. Such a reversal of capital flows could spark tectonic shifts in forex valuations in the coming years, amplified by national industrial policies that will privilege domestic industry over imports. These are the deeper secular forces that will shape the monetary battlefield. While breathless headlines focus on whether the Fed hikes or cuts at its next meeting, wise investors would be prudent to train their sights on the bigger shifts already underway, who wins and who loses in a world of gated economies? To what extent will Western democracies disentangle their strategic links with autocratic capitalists? How will the fracturing of supply chains redraw the map of economic power? As an American, it has been comforting to watch the US dollar emerge as a safe harbor during this period of soaring uncertainty. There is a special status afforded to those whose currency reigns as the global reserve, a boon for American borrowers and consumers. The stubborn resilience of King Dollar through the recent global tumult has flattered our national ego, allowing us to indulge the conceit that our dominance is impervious to the entropy appending the old order. And yet, the dollar's unexpected reversal this spring offers a bracing counter-narrative, a reminder that no hegemon's reign is permanent, that today's strength can paradoxically breed tomorrow's vulnerability. For all our self-satisfaction at America's exorbitant privilege, we may come to realize that preserving the dollar's standing requires deeper domestic reforms to bolster our industrial commons and human capital. Easy money can paper over rot for only so long. Navigating this transitional moment won't be easy. We are passing through a phase change that will try the souls of both investors and citizens. Prudent portfolio managers will need to combine technical mastery with a broader philosophical framework about how the global system itself is being rebuilt in profound ways. The forex rates flashing on their terminals are the mutable symptoms, but the deeper paradigm shifts underway may take years or decades to fully unfold. Have we the patience and wisdom to not just analyze the volatility, but truly understand the tectonic economic transformations from which it stems? Can statesmen forge a path of economic revival that transcends the old globalization mantras and forges a new model of national resilience and cooperation? Our future prosperity may depend on answering such questions. As intellectuals and ordinary citizens alike grapple with these profound shifts, we would be wise to appreciate the paradox that the dollar's short-term stumble embodies. What seems like an ephemeral market move is simply the surface oscillation. The deeper rumblings below portend far more momentous realignments that will shape the nature of economic power for generations. Managing these transitions with grace rather than rancor will be an existential test for our era. In assessing the dollar's reversal, it would be easy to fixate on the Fed's next tactical adjustment, but the Solons of Wall Street who busy themselves with such myopia may be missing the forest for the trees. To truly understand this moment, we must broaden our aperture to appreciate the deeper forces destabilizing the old economic order, even as we remain humbled by the profound uncertainties that lie beyond this phase change. Only then can we hope to navigate the paradoxical times ahead with wisdom and courage.